Morning, everyone. Welcome. I'll start again. Good afternoon and good morning, everyone. Welcome to this panel on emissions trading in Asia, opportunities, risks, and disputes. We are truly delighted to be holding this panel discussion today on a cutting-edge topic that is growing in prominence around the world, but particularly in Asia. We're grateful to SIAC for hosting this event, and we have the privilege of a highly expert panel, which I will introduce in a moment. But before I do, let me introduce myself. My name is Nicola Piet. I'm a senior associate at 3 Crowns, and due to a last-minute change of plans, I'm stepping in for Catherine Kanzi to moderate the panel today. Joining me on your screens are, starting with Felix Say, then Peter Zaman and Mark Lassotti, our 3 speakers. Felix is General Counsel at Pavilion Energy, which is wholly owned by the global investment company Temasek. Pavilion Energy serves as the global energy merchant for Singapore with a worldwide portfolio in liquefied natural gas, as well as a physical presence in the downstream energy markets of Singapore, Europe, and the United Kingdom. Legal 500 describes Felix as an extremely well-regarded lawyer who spent nearly a decade at Gazprom before his move to Pavilion in 2018. Welcome, Felix.
Thank you, Nicola. Thank you for inviting me.
Peter is a partner at the law firm Holman Fenwick Willen, or HFW. HFW is a leading global sector-focused law firm that is built around providing full-service offerings in the aerospace, commodities, construction, energy and resources, insurance, and shipping sectors. The firm has offices across the Americas, Europe, the Middle East, and Asia Pacific, and Peter is based in HFW's Singapore office. Peter has over 20 years experience as a transactional lawyer in the UK, EU, and Asia, specializing in commodities, derivatives, structured products, and of course, climate finance. He is recognized as a global market leader in this field, and we're delighted to have him on the panel today.
Thanks, Nicola. It's a pleasure to be here.
And finally, Mark is Chief Operating Officer at Climate Impact X, or CIX. CIX is a global marketplace and exchange for high-quality carbon credits. CIX was born out of a public-private initiative in 2020 called the Emerging Stronger Together Task Force, and it was driven by the Singaporean government to explore opportunities to scale the voluntary market. Day-to-day Mark oversees risk, operations, finance, legal, and compliance issues, as well as human resources at CIX, and he previously held leadership positions at Alphadyne Asset Management, Goldman Sachs, and JP Morgan. Mark, thank you for being here today.
Great, Nicola. Very happy to be here.
So with that, let me briefly outline our discussion today. As you'll see on your screens, we'll deal first with an overview of sorry, excuse me a moment. First, we'll deal with an overview of ETS emissions trading schemes, including voluntary sector, but as also the regulatory market. Next, we'll deal with issues relating to risks and opportunities for those that participate in those markets. And then finally, we'll close with a discussion about disputes and dispute resolution. We may have a few minutes at the end to deal with questions, so I would encourage anyone who's listening to please write your questions to us in the box that's available on Zoom. And if we have a moment at the end, we'll turn to those. So if we can turn to ETS overview, that's the next slide. Felix, perhaps you can start us off with our discussion by describing the current state of play in Asia and in particular Singapore.
Will do. Next slide, please. Carbon markets, just like any other market, there's an element of policy involved in driving the market. I think carbon markets are like none other. In particular, compliance carbon markets is actually an instrument of climate change and economic policy of a country or region or of a trading bloc. Even in voluntary carbon markets, where companies make a pledge regarding sustainability or net zero commitments, they also take their cue from the signaling of the relevant countries and jurisdiction. Some reasons why companies might enter into carbon markets is because they want to learn more about carbon markets, because they're influenced by, or they want to influence policymakers. A lot of companies today want to generate goodwill differentiate themselves in the market and manage their sustainability, ESG, or corporate social responsibility obligations. It may be a response to pressures from the supply chain or pressures from their stakeholders and shareholders, or to engage their staff by making a pledge regarding their sustainability and their carbon footprint. So if we take a look, we are in Singapore. What is the Singapore position on this and the policy position on this? It is that by 2030, Singapore has committed to reach their peak emissions. And by 2050, they're committed to half that amount and achieve net zero emissions by or around the mid-century. The main policy tool, and it's not the only one, but certainly the one that is the most prominent, is the carbon tax, which is already in operation, but the rate of the carbon tax will be lifted for those affected installations to 25 Singapore dollars per ton of carbon dioxide equivalent in 24-25, and then stepping up to $45 and possibly reaching up to $80 by 2030. You can see how all these policies work in tandem with each other to achieve their goals. And that is the signal that it is sending out to market participants about the climate change policy, as well as maybe carbon pricing, which I'll talk more about later. Our shareholder is Temasek, and in line with that, Temasek is also committed to reducing their net emissions from their portfolio to half of 2010 levels by 2030. So on that, what is the opportunity for Singapore? Can I have the next slide, please? There is an opportunity to establish Singapore as a major carbon hub in the world. And on this slide, I've illustrated what would be the most long-standing and liquid hub, I would say. That would be the European Union emissions trading system. There is a China emissions trading system that has been live in several provinces, but now on a more national scale for a couple of years. Japan, Korea, New Zealand, Australia also have ETS. They can be more described as compliance markets. As I've just gone through, Singapore's main policy tool is a carbon tax. So right now there is no emissions trading system in Singapore, although they are allowing certain high quality international carbon credits to be surrendered in lieu of paying the tax in a couple of years' time. So therefore, to me, there's a clear opportunity for Singapore to be the hub of trading such high quality in the international carbon credits. What can we do to drive Singapore to become a hub for carbon activity? As a company, Pavilion Energy, we supply more than 30% of natural gas for generating electricity to Singapore. And we have taken lots of efforts to decarbonize the value chain of LNG to potentially one day reach net zero status and having carbon neutral LNG. Our company imported the first carbon neutral cargo into Singapore sometime last year. We also need, in order to establish a carbon trading system within Singapore, we have to ensure a registration and enforcement system infrastructure is well placed. That's to ensure that carbon credits are not sold more than once. It needs to clarify the ownership and have a system to track it. It would be fantastic if this system is publicly available so that authorities or other stakeholders or anybody can see the transparency in the movements of carbon units. I know that Singapore is already working with the World Bank to host some aspects of a carbon registry to be hosted in Singapore. My own opinion also is that Singapore can also play a leading role in clarifying the legal treatment of carbon units. And I know the audience today is mainly made up of legal practitioners. So you'll be interested to know that at the moment, a voluntary carbon unit is not underpinned by any legislative framework, and there's no associated regulatory structure as yet. What is it? Well, there are some English law cases that have discussed this, but carbon units could be a bundle of contractual rights. It's most likely intangible. Is it a shows in action? I'm sure some of the audience would be better placed than me to opine on this, but there is really a fertile ground to discuss this topic. if there is clarity on the legal treatment of carbon units, I can just imagine all the financial services providers and all the other professionals within the Singapore hub as it is today can find opportunities to build a more vibrant market. I think that's all I have on this topic for now.
Thank you, Felix. That's fascinating. You've described Singapore as being a major global hub for trading carbon offsets, including offsets that are generated in compliance schemes. It might be helpful at this moment to take a step back and consider some of the terminology that we're using. And so, Mark, I wondered if you might come in and help us understand the difference between a compliance market on the one hand, such as the EU ETS, and the voluntary market. And perhaps in answering that, given your involvement in the voluntary market, you can also describe current trends and SIAC's role in that context.
Sure, Nicola, very happy to. And Felix, thank you for the very nice tee-up and explanation provided. So as Nicola started to allude to, where SIAC plays is mostly in the voluntary market. So drawing a distinction between a compliance market and a voluntary market, the compliance market is set up to enable countries and companies to fulfill obligations under the Paris Accord. This is the regulated market within each of the jurisdictions. And as you saw in Felix's slide, the EU ETS, Australia ETS, Korea ETS falls within the remit of the compliance markets. Where SIAC plays more and is expanding and creating our capability to come to market is around voluntary markets. The voluntary markets function in complete parallel to the compliance markets, and it doesn't necessarily fill a legal obligation as yet. But the demand for voluntary carbon credits is growing hugely, largely due to stakeholders, pledges, and company commitments into driving to net zero. And then one of the key distinctions between the two markets is that the carbon credit units in a voluntary market are issued through standard or registry setters like Vera, Gold Standard, who focus a lot on nature-based credits, and Cook's Roads, and then Pure Earth, which is actually a new up and running registry focusing on tech removals, which will probably be the look forward in where the credits can come from. So also underpinning this then is, as you're going or understanding how would you use a carbon credit. Carbon credits, as we think about it, have actually a mitigation hierarchy. And we look to carbon credits to compensate or prevent emissions outside the value chain, but these are the very, very hard to abate emissions. Really, what we're trying to achieve here is a more broader look through you neutralize, in other words, remove residual emissions, you substitute existing technology through renewable energy, you reduce through processes, reduce emissions, change the way you do things, or ultimately prevent emissions, which is probably the longest. You phase out old products, phase out old projects, phase out old ways of doing things. But voluntary carbon credits can, throughout this entire process, be used to compensate in the drive to net zero. If you go to the next slide, please. What it's going to touch on here is to give you a scope. Correct, thank you. Give you a kind of just an indication of how quickly the voluntary carbon market has grown. And on the left-hand side, you'll see the graph, which is only in recent times from 2017 through to 2021. The growth has been astronomical, both in credits being issued and retirements that are being placed by the beneficial owners of the credits. Through work done with McKinsey, the overall carbon market, voluntary carbon market, is expected to grow up to 15 times by 2030, and even projected up to 100 times by 2050. So we're really at the start of this, and we believe that the forward-looking approach in this market is really, really going to be very big. If we go to the next slide, please. So if you understand, and to help the audience understand and just how SIAC is fitting into this. So as Nicola kindly introduced us, we are coming to market, and we're coming to market in a way we think is going to be really relevant to provide the basis and the platforms for both suppliers and buyers to come to market. So we have launched our project marketplace that went live in Q1 this year. This is largely for corporates to buy and retire. It's largely probably in a primary issuance basis as well, but project developers having an avenue to come to market. We're very shortly going to be launching our auction platform. Again, the auctions by pure nature of it are going to be highly curated, highly publicized, highly profiled of suppliers bringing a large quantity of primary issuance credits to market. And the primary target audience could be anywhere from financial investors, commodity traders, or the corporates. And then as we look out towards the end of the year, we're looking to have our spot platform up and running. Now, spot platform is largely going to be focused on standardized contracts. These are going to be really targeted against financial investors and commodity traders. And obviously, in partnership with our shareholders, SGX, we will look to use the spot market to evolve into futures and futures capability, which you see quite a number of the counterparts across the world evolving into as well. Happy to pause there, Nicola.
Thanks, Mark. Evidently, the voluntary market is becoming increasingly important and prominent, and you've helpfully clarified the distinction between regulated compliance markets and the voluntary market as well. Some of our audience might be interested to know how these markets relate to global efforts to address climate change under the Paris Agreement. And so, Peter, I wanted to turn to you next. Perhaps you could describe this in a little bit more detail.
Sure, very happy to. I think most members of the audience will be familiar, or at least have heard of the Kyoto Protocol. And if anything, the Kyoto Protocol gives us the foundation for today's carbon markets. You know, carbon markets are an alien concept. If you go back to sort of 2001, most people would never have heard of what a carbon market is or was. And the reason why we have what we have today, whether that's by way of voluntary markets or the Paris Agreement markets under Article 6, is because of the experience we gained through the Clean Development Mechanism, joint implementation, and emissions trading, which were the three mechanisms created under the Kyoto Protocol to allow countries that had taken on cap and trade targets in respect of their greenhouse gas emissions to acquire carbon offsets from countries that didn't have any caps and import them to try and help them meet their targets under their Kyoto Protocol obligations. Now, let's be real, the Kyoto Protocol country obligations were not great. I think it was an overall average of 5% below 1990 levels for a number of countries who really didn't have to do that much to try and reduce their emissions to meet those targets. But it was a lot of new experimentation, learning by doing, if you will, to the point where we get to where we are today. So I think it's worth understanding the journey of emissions trading markets, both compliance and voluntary, to try and explain what it is that we're dealing with today and why it is the way it is. And I think the easiest thing to recognize is the countries that did have cap and trade obligations, essentially, under the Kyoto Protocol, introduced the EU emissions trading scheme, which is the first example of an international compliance carbon trading market. And that was essentially the EU member states pulling together 28 countries and agreeing on a common basis for trading carbon, and essentially agreeing a common cap between those 28 countries and then distributing the cap amongst themselves. So that is the foundation for compliance markets, and the experience that other countries have drawn, whether that's the Chinese ETS, the Korean ETS, California ETS, are all based on the experiences of the EU ETS today. And as you know, today the EU ETS allowance price is in the region of 70 to 80 euros a ton, and therefore it's a significant compliance market, and therefore the value of the compliance credit traded there is quite high. Contrast that to the lessons we learned through the Kyoto Protocol of the Clean Development Mechanism and the joint implementation. Those were mechanisms to create offsets. Offsets meaning for every ton of carbon emission emitted, if that was in a GHG accounting +1, so an emission is a +1, an avoided emission or a reduced emission is a -1. So carbon offsets, as we consider them in the context of the voluntary market, from an accounting perspective, represent that -1. So if you are a country who has got emissions and you need to find a way to reduce your emissions or the impact of your emissions, one way to do so is to say, well, for every 1 ton I've emitted, if I've acquired and retired a -1, then from an accounting balance sheet perspective, my balance sheet is flat. Now, the Paris Agreement, as you know, is a representation of 193 countries, I think I remember correctly, getting together and agreeing to essentially try to get to a 2 degrees or below 2 degrees target, ideally 1.5 degrees. And in order to do that, they basically have to peak their global emissions by middle of the second half of this century. Now, in the 1.5 degree target context, that means peaking your emissions by 2050. And Felix has already outlined how Singapore is aligning themselves with that vision. And in order for some countries to do this through their own domestic abatement, they take on targets under their nationally determined contributions under the Paris Agreement. And unlike the Kyoto Protocol, where only a handful of countries took on some kind of climate change commitment, the design of the Paris Agreement allows all countries to contribute in differentiated ways. So the net benefit of the Paris Agreement is we're all in it together. We're doing it at our own pace, some doing more, some doing less, but we're all doing something. And I think the context of where Article 6 comes in is to try and represent market mechanisms within the framework of the Paris Agreement that allows countries to work together with other countries to find ways of enhancing their ambitions towards meeting climate change goals. So one example would be if a country like Singapore says, I'm already incredibly energy efficient, I have limited resources, my ability to therefore rely on renewable and other sources for making myself more ambitious from a climate change perspective is hard, but I would be very happy to work with other countries who have more abundance of those resources and therefore import their emission reductions towards meeting my own NDC targets, then that's one way for Singapore, by way of example, to take on greater ambition under the Paris Agreement. So the mechanism by which it would work with other countries is essentially the Article 6 mechanism. And there are 2 market mechanisms built into Article 6. One is 6.2, which is a bilateral or multilateral arrangement so the countries could tailor-make how they wish to work with other countries. And that is called cooperative approaches under 6.2. And the type of unit that you can generate through a cooperative approach is called an internationally transferred mitigation outcome, or an ITMO. And the type of activities that you can lead towards generating ITMOs are not just limited to emission reductions. If, for example, in the process of adaptation financing, you achieve co-benefits through adaptation financing, then those co-benefits can be represented in the form of an ITMO for the purposes of an Article 6 transfer. So that allows for carbon financing also to be supplemented by mitigation financing or co-benefit financing in a way that hasn't historically been done before. Taking Article 6.4 by way of contrast, this is more of a centralized mechanism operated by the United Nations Framework Convention on Climate Change. And the idea there is that the type of credit generated is a Article 6.4 emission reduction or an Article 6.4 ER, bit of a mouthful, but you get used to it. And it behaves a bit more like the clean development mechanism did under the Kyoto Protocol. Now, in the context of both of these markets, the rule book to support these markets did not really exist for quite some time, even though the Paris Agreement itself had become operational in 2019. So the issue was, despite most of the rest of the Paris Agreement rulebook becoming operational, the rulebook for Article 6 was missing until it was agreed last year in Glasgow at COP26. Next slide, please. Next slide, please. Okay, so just taking a slightly deeper dive into Article 6.2, one of the most important things for private sector participants in the 6.2 context is that the Paris Agreement's framework does not contemplate the participation of private companies in Article 6.2 mechanisms by default. It doesn't prohibit it, but it doesn't expressly allow it. So then the question is, do private sector entities get to participate in cooperative approaches pulled together under 6.2? And I think the better view on that is that if the two countries or participating countries so agree and authorize private sector participation, then it's not prohibited by the Paris Agreement, and therefore the countries may allow that. But one of the important elements in that is, of course, the framework by which the private sector is authorized has to be established by the contractual or international treaty framework put in place between those countries. So if you don't have an international framework that expressly authorizes private sector participation, question mark whether or not this just remains as an intergovernmental arrangement where no private sector companies can otherwise participate. There are a number of existing cooperative approaches already in place. Switzerland's been very, very active in this, and they have put in place a number of bilateral arrangements with a number of countries like Peru, Ghana, with Georgia, Senegal, etc. The Japanese government has something called Joint Crediting Mechanism, or the JCM, which they have been initiating from pre-Paris Agreement stages, which is not designed to meet the Article 6 requirements, but if you upgraded it, could probably meet the Article 6 requirements and become cooperative approaches fairly quickly. And last but not least, there is an initiative being led by the World Bank involving, I think, 11 countries, if Singapore is one of them, who are thinking about looking at a global, if not a sort of 11-country group trading market amongst themselves. Next slide, please. Just another segue into the 6.4 mechanism. I mean, just to give you a feel for this, because it's centrally operated by the United Nations Framework Convention on Climate Change, that's the treaty level body. They subdelegate it to a supervisory board, and that supervisory board is supported by the Secretariat to the Paris Agreement, and they together will operationalize and run this market. Generally speaking, in order for this market to become operational, you need to build infrastructure, including a carbon registry. There has to be an agreement of what kind of methodologies are acceptable for the purposes of the 6.4 mechanism. And those methodologies are the ones against which the carbon reduction is measured and tested. And last but not least, you can't really participate in the 6.4 mechanism if you don't play ball under the Paris Agreement rules, which means that there's an eligibility test that countries have to meet in order to participate in 6.4. And that's actually very similar to what used to happen in the CDM days. The one thing that is very, very clear about 6.4 is that it does anticipate private sector participation in this market, and therefore has, as part of the guidelines that came out in COP26, created an authorization framework for how private sector participants will be authorized, how projects will be approved, and how the units in question may or may not be authorized for Paris Agreement use or for voluntary use. I will stop there and I will hand it back over to you, Nicola.
Thank you, Peter. That's an extremely helpful background to what's been happening in the international climate treaty negotiations and how all of these markets fit in with Article 6. So thank you for that. With that background to emissions trading, including the state of play in Singapore, thanks to Felix, we turn next to discussing risks and opportunities. This is the next item on our agenda. Mark, I turn to you first. SIAC is a marketplace for exchanging high-quality carbon credits. Could you provide us with some insights into the types of risks that arise in the context of sales and trading, and how SIAC addresses some of those risks?
Sure, Nicola, absolutely happy to. So we have, perfect. So if I look at the roles of sales and traders, I'm coming down to probably a more practical aspect of this. In sales and trading, you're going to look at, are you buying, or what's your purpose of buying? Are you buying the secondary market? Are you looking to trade? Are you building? Do you have sale considerations and you have corporate buyers behind you that are looking to buy voluntary carbon credits to offset against their targets of what they've set? So if it's a sales consideration, which is a buy to retire, your strategic choices are going to be around the types of credits you want, the geography of the projects. That all has to fit into your narrative of the project, of your marketing objectives, of your company objectives. And some of the key project risks associated with this and quality considerations will be things like additionality, leakage, permanence, which I'll go into a bit more detail later on. On the other side, of the secondary market side, if it is a trading house, if it is a portfolio manager, if you are looking to build an inventory of it, your pre and post purchase considerations are slightly different. You're looking at the project risk ratings, some of them which we touched on earlier. You're looking at monitoring and how are these substantiated going forward in permanence. And you're also looking at counterparty risk. And what is your credit risk assessment of how you're picking this up? And then also, finally, is your delivery of the credits into the registries. Now, the registries I indicated earlier being Vera, Gold Standard, Puro. Credits, the voluntary carbon credits, are not fungible across the registries. They are issued by the registry and will need to be retired within that registry. You can't take a Vera credit and go and retire it in Gold Standard. It's not the way the system is set up to do. So it's very important that connectivity or that ease of being able to transact and your connectivity back into the registries. If we go into the next slide, please. So understanding this and understanding then how SIAC has set ourselves up to look at how we deal with this. So I'm going to touch on really our commitment to trust and our quality criteria. So if you think about it, the registry immediately has an initial quality criteria for every project to meet, for any credit to be issued. And so they'll go through a relatively fast due diligence around verifying that the project exists, there are benefits related to it, it is going to be permanent, there is additionality, and so forth. So once the credits are issued, what we're putting forward or what we're building in SIAC is a trust in the product, understanding that what we're listing on our exchange are high quality credits, trust and execution, ease and trust and execution. Simply put, for suppliers and buyers to come to the market with little or no hassle and be able to transact in confidence and integrity in the market. Then product use, what do you use the credits for? How are they used, and what are the co-benefits? Are there benefits that go back into the communities? Does it feed back into sustainability around the project that it came from? And then obviously then oversight in governance around double counting and risk monitoring. So the way SIAC is thought about this, we have our registry issued credits. We overlay that with a level of our own quality criteria, which we determine the carbon attributes. And we may take a higher view of what the registries have sometimes issued, because you will get different quality of carbon credits coming out. And so what we look in the attributes is additionality. We look for further benefits around permanence. Then we look for biodiversity. How have these credits impacted or supported the biodiversity of where they've come out? How have they impacted the environment of where they are? Thirdly, is we look at social integrity. FPIC is a key factor in that, but also dispute resolution, the local community engagement, and so therefore building your continued flow of how it comes through. And then finally, project governance, which falls into, you want double counting. You don't want a project developer to be able to go to two registries, list the same project and have credits listed or issued by two independent registries. And then, of course, the ongoing monitoring around how do you measure this. So what SIAC is looking to do is benefits to the buyers is by creating this community, by creating this forum where you can come in, you can understand what's going on. We run a community forum for buyers and suppliers where we invite our community to webinars, we invite them to events, continue to educate them on the evolution in the standards, core at what touched on earlier is ICDCM. The core carbon principles are due to come out later this year. That's going to be a very, very important benchmark for the voluntary market to start to set some baselines around understanding the carbon credits a bit better, and price discovery. Any new supplier coming to market, how do you determine what your credits are worth? We're offering price discovery both in the marketplace and the auction. Benefits to sellers, again, are giving an immediate platform and access to market, transparent price signals, being able to have confidence in coming to market, trust in the buyers that are there, and our overall management and review of this. If I just touch on one thing that I think may be slightly important is also forward selling. So what we define and what we interpret by forward selling, and what we're looking at is the ability for suppliers to forward sell credits on the market. These credits have not yet been issued, but the projects are in play. Understanding some of the nature-based projects could take up to 18 months to be able to actually be verified, measured, and for credits to be issued. And then how do you understand the risks around seller performance, buyer performance of the credits, policy risks around government changes, tax changes, as well as in pure issuance risks around late penalties, leakage, replacement, and so forth. So we actually have a completely separate stream around something, so we can bring a forward dated product to market as well. So I think I'll pause there, Nicola. I think that covered quite a bit.
Yes, thank you, Mark. And perhaps, Felix, I could bring you in here as well, because you also have significant insight into the types of risks that are faced by actors participating in emissions trading. So perhaps you could speak to how Pavilion Energy deals with those risks, including, for example, pricing risks.
Sure, Nicola, it would be good if we can have that slide that I have, I think slide 16, which would be bringing the audience to a little bit of a window into the world of an energy trader. So as you can see here in the purple box, is about generating power. That's what energy is about. And we have the usual players like coal, gas and liquefied natural gas, LNG. They are the main fuels of choice for producing, generating electricity. Oil is another option, but it is also very relevant that oil is the fuel for shipping, as well as all the other necessary aspects to generate your power. Weather is relevant in at least two aspects. One I would talk about is that seasonal patterns, like whether it's hot or cold, would drive electricity consumption, and so therefore your demand for your different energy products. And also renewable energy generation, which is right now a very important player. So the weather affects wind, affects solar. And in the middle of all this, we have carbon. So if you look at this, is this the world that we will have in the future with the carbon pricing as a key feature, along with all the other different energy commodities? Well, the answer is no, it's not the future, it's the present. What I'm showing here is the current state of play in the EU. After more than 15 years of the European Union ETS, the EU ETS, carbon sits right in the center of all this. And let me try to explain when I talk about spark spreads and dark spreads. For those who are not familiar, spark spreads is the difference between the wholesale electricity cost and the source of your gas. Whereas dark spread is the difference between generating electricity wholesale and the cost of your coal. So you have the price for your spark and the dark spreads. You look at which of the spread is greater or smaller, and you choose between coal and gas. But in Europe, we have what we call the clean dark spread, where people already take in the price of carbon, you add it to the price of coal, and only if that is lower than your price of gas and LNG, would you be using coal. If it's higher, then you'll be using gas. So all of these different aspects that go into your decisions on pricing is affected by carbon. And as you turn to more gas, because of the high price of the clean dark spread, you'll find it's maybe a better economic decision to go to renewable energy. And that's how everything is correlated already. And that is the current reality in Europe, where you have different markets driven by different fundamentals, but all together coming together to impact your power prices. Now, of course, I haven't mentioned the current geopolitical situation with Russia and Ukraine, which basically trumps all of these fundamentals. I'll save that for a different presentation. Next slide, please, Nicola. So when a company like Pavilion Energy or any other energy trader makes any decisions to trade in a commodity, enter a transaction, or make an investment, they will need to make an assessment of the price. Hopefully in the slide previously, I've illustrated why the carbon pricing is important. Because in order to make a decision as to whether you want to enter the long-term contract or invest in a carbon project, which could be typically up to 10 years or even longer, you sort of have to have a view, a forward price curve for what that carbon pricing would be in the next 5-10 years of your investment. You need to answer questions to your investors about what is the internal rate of return, what's the weighted average cost of capital, what's the cost of financing if you're going to project finance any of your activities. So it's necessary to have the market infrastructure to allow you to assess what the price is. In Singapore, we are very happy with Mark and his team to be setting up the SIAC. That gives us another opportunity to do price discovery. But based on what we have now, this slide quickly shows you that we have an exchange which is relatively popular at the moment, set up by the CBL. They have a product called the Global Emissions Offsets that tracks the price of CORSIA. They have a nature-based version, which is obviously higher quality, higher sustainability environmental impacts. You can see that's the green line that's higher. But that futures contract has only been in operation for about 1 year. It doesn't give investment or a trading firm a lot of confidence as to how to build the forward price curve at the moment. Maybe next slide, please. Apart from exchanges, what else can we do? Well, there are different publications like Platts that would do price assessments that can help you, can help investors and traders in discovering the price. But carbon credits are different, which is what Mark had been trying to explain, is that you have carbon credits from household devices like cook stoves. You have CORSIA eligible credits, which are accepted by the airline industry. You have the highest quality nature-based carbon credits. And these assessments, despite there being a 20-year or more history in voluntary carbon markets, it's only becoming this necessary infrastructure to help market participants decide on the risk and opportunities are only coming into play now. And we would need more of this in the future in order to mitigate and manage our risks.
Felix, thank you. Peter, you've written about a different type of risk that we've not yet touched on, and that's regulatory risk. Now, do you have an example of a regulatory or a legislative risk in the context of emissions trading that you might be able to elaborate on? And perhaps you can touch on any lessons, perhaps there are some, that we learned from implementing emissions under the Kyoto Protocol and how regulatory or legislative risks arose in that context.
Sure, very happy to do so. I mean, I was smiling as you were introducing the point because in reality, my role is nothing more than a risk manager, right? I'm a glorified risk manager, who happens to be a lawyer when it comes to people wanting to deal in carbon as an asset class. And yes, we have plenty of lessons to draw upon from our experiences already. So the slide that I'm going to use, which is on screen now, essentially is to try and highlight that part of the benefit of having lived through the EU ETS from 2004 till today, part of the benefit of having been part of the Kyoto Protocol dealing in CDM and GI transactions is that through the process of living through that experience, we kind of saw a lot of problems that perhaps the people who designed the frameworks did not anticipate happening. And part of that is because, if you put it very, very brutally, an environmental product like the one Felix highlighted, where carbon actually represents a value, and therefore a carbon credit within a trading framework represents an asset, because it allows you to either avoid a penalty or allows you to meet a compliance obligation. That asset, that environmental product, once it has value, it attracts capital. And when it attracts capital, essentially it attracts good actors as well as some bad actors. And sometimes you've got to watch out for what the bad actors could do in the context of the environment in which you're otherwise inviting the good actors to act. So, one of the big lessons that I suppose we took away from experiences in the EU ETS is, as a regulator, don't be naive about the interests that you will attract to your markets. So, for example, we have lived through fraud trading, so fraudulent trading of EU emission allowances within the EU ETS in order to recover VAT receipts and therefore do a runner before the VAT is actually collected and returned to the state. So we've seen plenty of VAT fraud transactions happen in the EU ETS. We've seen EU registry accounts being hacked, where carbon allowances were taken and stolen. And of course, then the big debate happened once the innocent buyer took those stolen allowances, not knowing they were stolen. How do you deal with stolen goods, right? Bona fide purchase of a value without notice. Do I get to keep them? And the answer was, well, it's not a good, so you don't get to call on that excuse. So you're not a bona fide purchaser because that is applicable only to a good. And as Felix has already mentioned, carbon allowances are intangibles and therefore they don't meet the definition of a good under at least the English Sale of Goods Act. So you don't get to call on those kinds of excuses. So you get to contextualize carbon as an asset class into a completely novel way of addressing legal points. We've even seen countries being naughty. So the EU emissions trading scheme allowed CERs from the Kyoto Protocol to be brought into the compliance framework, and compliance entities could surrender CERs instead of EU allowances to meet their compliance obligations. And those countries, in theory, were supposed to take those CERs and use them to meet their Kyoto Protocol compliance commitments. But those surrendered CERs were then, by corporates, were then being taken by certain host countries, member states, who immediately after the financial crisis thought, oh, wouldn't it be a good idea for me to sell these and make some money off it? And well, then that caused a big uproar because these were corporate units surrendered specifically for that country to use it towards its Kyoto Protocol, not for it to onward sell it and make money. So then you had joint implementation as a offsetting standard where countries who were subject to a cap decided that they could afford to sell their credits, but because they didn't do anything to try and earn the extra elasticity in their ability to sell, because if you were, for example, at that time, the Soviet Union breaks up, and then the industrialization process that built up your cap no longer exists, then artificially you've got hot air, essentially credits that you are able to sell, but not because you've decarbonized in any way, but because of fateful circumstances. So we've lived through all of that. We've seen suddenly the EU pull the plug on allowing CERs to be brought into the EU ETS, and CER prices go from $23 a ton to 30 cents a ton. And in circumstances where China was the biggest market, where CERs were being sold subject to a floor price of $10 a ton. So here you are entering into long-term offtake contracts, the forward contracts that Mark was mentioning. And in those circumstances, you thought you were buying them in a market where you expected it to be $23 a ton, subject to a $10 floor, and all of a sudden they're worth 30 cents. What do you do, right? And I think Felix and I can both talk about our respective experiences in helping various clients and in sort of finding ways to manage the risk that counterparties faced when they were caught with that. So where we are today, both in terms of the voluntary market and in terms of the Article 6 markets that I mentioned earlier on that are still to be built and fully made operational, is that they're going to have their own unique experiences. They may have some of all of the experiences, the bad experiences that I just mentioned, but they're bound to have their own unique versions of them as well. And therefore, essentially, risk management is where we anticipate having to go. So just in terms of lessons learned, I would say let's not ignore those lessons and let's not be naive in terms of building the legal frameworks we need to build to go forward. And if I could get to the next slide. One of the more unique things that I think is a particular problem under the Paris Agreement is something that didn't exist in the Kyoto Protocol. So in the Kyoto Protocol, you had 38 countries who had taken GHG targets, and basically you had 170 countries, 150 countries who basically said, I don't have to do anything vis-a-vis my carbon commitments. The Paris Agreement changes all of that. Everybody has some form of carbon commitment. So the world, that was simply divided between those who don't have to do anything, and therefore anything they did was additional and anything they did was voluntary, versus the world today where everybody has to do something. So what on earth is additional anymore is going to be a big problem going forward. So countries who have NDCs have to now be able to meet their NDCs. And those countries who never had to do anything before suddenly realize they don't have any laws to regulate carbon emissions in their countries, yet they've signed up to commitments on NDCs that involve them regulating carbon emissions in order to drive a particular NDC result. So we anticipate, and we've seen this happening in a number of countries, where countries will pass legislation saying, hang on a second, all of you guys who are out there managing carbon abatement opportunities up till now, who've been doing so without any oversight, any regulation, and it never mattered because, frankly, under the Kyoto Protocol, we didn't care. We now care. And because we now care, we now have to get our hands around and get a grip with all these opportunities as they happen in my country, because I might need those carbon abatement opportunities to meet my own NDC. So therefore, we call it nationalization risk, where essentially you nationalize your carbon inventory capability or carbon reduction capability. And even if you don't ban it completely, you still want control over it. So we have examples where in the days of the clean development mechanism, none of the other countries did this, but China said, China passed a law saying we own all emission pollutions, right? We own it. You want to deal in emission pollution reductions? You come to me. And essentially, we can anticipate that kind of a restriction being imposed by every country who is going to be essentially an exporter of carbon offsets going forward, whether those are ITMOs, whether or not those are 6-point ERs, and even whether or not they are voluntary carbon units. We can anticipate that happening, because how else does a country ensure that they meet their NDCs? That's the point. So one example, and the next slide, please. Where a country has already taken steps to do that is Indonesia. So Indonesia has passed Presidential Regulation number 98. That regulation basically says all carbon reduction activity must now pass through the authorization and approval process of the Ministry of Environment and Ministry of Environment and Forestry. And therefore, without our consent, any activity otherwise is not authorized and is therefore illegal. And by the way, we haven't yet decided whether or not we're going to let you, even if we approve your activity, sell your carbon credits, because for that we need a secondary piece of legislation. We're waiting for that legislation to be finalized. Once we know what that one says, maybe then you can sell these things. But until you get that piece of legislation, hold tight, you're not going to do anything with our carbon offsets. And of course, if you imagine the contracts that existed pre the passing of this legislation, where there was no regulation of the purchase of or sale or restrictions around the sale or purchase of these credits on a cross-border basis, and suddenly you have this regulation, everybody now wonders, well, now, does that mean for my contracts? So it's a ripe and futile circumstance where you look at change in law clauses, force majeure clauses, where you basically look at scenarios where somebody will basically get burnt by the arrangements. We don't know how badly yet, but it could be very badly, it could be not too badly, or it could be somewhere in the middle. We'll know once the secondary legislation is published. But now play that scenario out at every potential country going forward, because all of these countries have NDCs, and all of these countries are potential hosts for project activity, whether that's, again, voluntary 6.4 or 6.2, doesn't matter. The concept is that the risk exists no matter which one of those activities you look at. And hence you get to, from a supply side perspective, confusion and regulatory uncertainty.
Peter, thank you. I think that sets us up perfectly for the next part of our discussion, which is to discuss disputes and dispute resolution. We've had a very rich discussion about risks, opportunities, and Peter, you touched in particular on the regulatory market, but we also dealt with the regulatory framework, but we also dealt with market risks as well. Peter, perhaps we can start with you and discuss disputes now. What are the contexts? You've mentioned a few, but maybe you can elaborate on them further. What are the contexts in which emissions trading disputes are likely to arise or have arisen, and how in practice do you see them being dealt with?
Okay, so there are a couple of ways in which to think about this. So if I take SIAC as an example, SIAC is a platform where people will buy and sell, right? And the net result is they're going to get their hands on a carbon offset of some sort. And therefore, anybody who's acquiring carbon credits will be signing up to their terms that SIAC require them to sign up to. Now, apart from that type of market infrastructure where those terms are relatively non-negotiable and standard, you have over-the-counter bilateral sales, which in today's market represent the majority of transactions. So for over-the-counter transactions or bilateral agreements, essentially it's what you agree with your counterparty. And in the voluntary markets, there are no standardized contracts yet for the origination side of the market. The secondary side of the market, the compliance side of the market, is a lot more developed, and there are standard form agreements for that. And in those standard form agreements, generally, because these are compliance frameworks within countries that regulate it through statute, the dispute resolution clause is typically local courts or the relevant local jurisdictional courts. But if you're starting to do cross-border deals, then you start worrying about the ability to enforce court awards. And in the origination market or the primary markets, that is a more fundamentally important issue, because a lot of the activities that lead to these emission abatements, and therefore your local counterparties, are in jurisdictions that haven't necessarily ratified the necessary convention for the enforcement of court decisions. So there is a greater list of countries that have signed up to conventions like the New York Convention on the Enforcement of Arbitral Awards, which then leads to you wanting to put more arbitration clauses into your primary market origination contracts. And in the context of those primary market arrangements, again, it's up to the parties to decide what they would like. So because we are being hosted by SIAC, let me do a little bit of a localized view on things. For a lot of our Southeast Asian contracts that we're negotiating, SIAC ends up being quite a popular choice of dispute resolution clause, mainly because whether or not you're doing a project in Indonesia, Thailand, any other part of Southeast Asia, both counterparties have to be comfortable on a common arbitral forum. And SIAC ends up being quite a popular choice because it looks like a more of a neutral in-between choice in this part of the world, as opposed to LCIA, ICC, or some other choice of arbitral forum. But there is a big mix of dispute resolution forums out there. In terms of the types of dispute we see, well, unfortunately, even in today's very early stages of the voluntary market, my partner Dan Pereira and I are already involved in quite a number of disputes associated with projects. And we're seeing essentially people wake up to realize the value of transactions they're involved in. Things that perhaps they ignored in the past because the value was less. Now they realize there's a lot of value in it, so therefore they've gotten more serious about things, and therefore those disputes are now coming to the fore. Small things, $20 million claims where one person believes the value of the other person's contribution is $300,000. The other person thinks it's worth $20 million. That is a very big gap in which to bridge people's opinions. So inevitably you fight over it. And that's just a small example that I can give. But I think maybe the others, my other panelists, will have more personalized views and takes on how they see disputes.
Yes, indeed. And perhaps Felix and Mark, we can invite you in here too, because you will also be very closely familiar with legal instruments that are being used in emissions trading that contain dispute resolution clauses. Felix, in your experience, is arbitration or another form of dispute resolution being used in commercial contracts? And if so, why? If so, why not arbitration? And then perhaps we can turn to Mark. Perhaps you can explain how SIAC has arrived at the dispute resolution clauses in its contracts.
Right, Nicola, yeah, to answer your question, our preferred choice, subject to what Peter has advised regarding the different countries and whether or not they signed the New York Convention, etc., on enforceability, is arbitration. And the reason is because SIAC is hosting this webinar. No, it's also because of confidentiality. No one wants to air their dirty laundry. And it's because, dispute resolution, you want to resolve the dispute and you want to maintain a relationship. So I think those are very primary considerations, no matter which asset class or which commodity you're dealing with. Another point I want to make is that when there's a possible breach of contract or when you suspect something like that, dispute resolution is probably the last resort tool. There are other tools that you want to already build in to your transaction, to your investment, to avoid having to go to dispute resolution. The first port of call, you will always do a credit assessment, and you think about what type of credit support, like guarantees, banks, letter of credit that you can take. That avoids a bit of enforceability, although it doesn't completely eliminate it. If it's an investment, you might want to think about, the equity holding, whether it comes with a board seat or, management reporting and all those sort of things that allow you to keep better control over the operation of a project. Here, we're also talking about, like in this particular example, I'm talking about investing in carbon offset projects, right? So it's very physical and tangible in nature. So there are going to be local communities or local presence that can be affected. So therefore, you may be able to apply pressures in different ways. And if your value is only from carbon units, then you're sort of stuck. But if there are co-benefits, which Mark had previously mentioned, co-benefits refer to things like the United Nations Sustainable Development Goals, where the investment you make into a carbon offset project produces some other benefit for the community or biodiversity. So there could be values in things other than the reduction of greenhouse gas emissions, which would make an investor or someone involved in a transaction look at a possible breach of contract in a different light, before taking the last resort option of going to arbitration.
Yeah, thanks, Felix. If I can just jump in. So just at SIAC, the way we've approached this, and we are still very early in our journey, but we are Singapore incorporated. So we take the opportunity where at all possible to ensure Singapore governing law and SIAC arbitration. Arbitration, I completely agree with Felix, is for confidentiality purposes. You don't necessarily want everything aired in public. And I'd like to just draw a distinction out. So there is obviously dispute resolution mechanisms we have in our agreements for the members to resolve disputes, however they may come about. And there could be a variety of reasons to work through that. And this is a hyper fast-moving environment, and being adaptive to how the environment and the needs are changing within the market participants. But just drawing the distinction between default management. We also need very strong ability to protect our platform, to protect the integrity of the platform and protect the players that potentially are trying to come to our platform, and how we're able to ensure that continuity and confidence and integrity remains within the ability for our participants, both buyers and suppliers, to come to the platform. So it's, as I said, very early in our journey. We are anticipating that these demands will change. We will have to adopt and evolve with them. And we also see a very, very strong an ask and request from a lot of customers coming on platform is, what are through all the work that's done in generating carbon credit, what part goes back to the community? Which part goes back to community, and how do you ensure that that part goes back to the community? And that will fall back down onto the methodologies employed by the project developers to get rated. And if you go to RED Plus or and so forth, there are very strong guidelines and very strong ways in which the local communities can benefit or do benefit through the production of carbon credits.
Thank you, Peter. Thank you, Felix and Mark. Peter, perhaps I can turn to you to close our discussions and invite your perspectives on the current and future landscapes of emissions trading disputes. We'll start with you, and then if Felix or Mark, you have any contributions, we can turn to you next.
Future disputes are disputes that we haven't yet contemplated, and if I could contemplate them, I would be advising my clients today to avoid them. So I think the future disputes are the ones that are unforeseeable or unforeseen at this stage. I mean, look, one of the graphs that Felix showed you was the sort of sign of demand going up as well as prices going up, right? And, there are some people who think that carbon allowances will easily be worth $50 a ton within the next 10, 15 years. Now, a lot of these contracts that are being negotiated today are relatively short contracts in the sense that your immediately delivery obligation is probably limited to the next 5 years. But because you're getting involved with the project at its origination stage, and these projects can have crediting periods renewed, there is potential that these projects last 15 years. Now, if that were the case, and you now have that price thing going up, and yet you've pre-agreed the price for the next 15 years today, you can see the other side wanting to get out of that contract quite desperately very, very soon, because they're going to realize that they made a bad bargain, and that's not a great way to build a long-term relationship. Now, those are the areas where I think there are plenty of fertile ground. Some people say, well, okay, I'll have the option on renewing, in which case one party gets to choose whether or not to renew or not. The other side may or may not then have a say in the price, or the price might just be a floating price rather than a fixed price. And even if you take the floating price, if the floating price goes down, you can immediately see people saying, well, actually, I don't like that floating price. I want a different floating price. And just as you have price review mechanisms for LNG contracts that cause plenty of heartache and plenty of concern, you might land up needing carbon price review provisions in your own agreement to try and deal with those issues. And right now, people are not dealing with that in their contracts because nobody's looking that far ahead. So with all of us collectively, it seems today, agreeing that we should make SIAC the default venue for resolving these disputes, I think SIAC will probably be hearing a few of these disputes at some point in time in the future. So I'll leave it there, but I'm sure there are plenty of anecdotes that Felix or Mark might want to throw in.
Well, perhaps on that note, we can close the panel discussion and turn to the Q&A. We have around 10 minutes left, which I think is a perfect time to address a few of the questions that have come up from the audience and some of my own questions as well, if we have time. So one that has come up on the chat, it concerns how we assess greenhouse gas emissions from a company perspective, but also who the type of actors are that participate in these emissions trading schemes and how they become involved in them. And so I wondered if I might call on you, Mark, and Felix to address these two different points. Perhaps Felix, you can talk about assessment of emissions, and Mark, you can perhaps give a perspective on the actors that are involved and how they become involved in these emissions trading schemes, whether it's compliance markets or voluntary markets. Over to you first, Felix.
Sure. So I think the question came about when I was talking about Singapore's carbon tax. And so if you're a reportable facility, you would know about it. The NEA would have been in touch and you would have been subject to it already. And the rules of your emissions assessment or measurements, it would be clear enough. There will be protocols. But I don't want to leave it there because there is a very strong trend on needing to know what your carbon footprint is. And there is a whole protocol or standards out there that are being applied. It's the main one is called the Greenhouse Gas Protocol. But the standards are developing, and it's fairly clear that you can measure your scope 1, scope 2, and scope 3 emissions. I don't think we have time to go into what each of those means. For ourselves as a company, we are a Temasek portfolio company. I presented earlier that Temasek has a commitment on their emissions, so they require all the Temasek portfolio companies to measure their scope 1, scope 2, scope 3 emissions and report on an annual basis back up to the shareholder. And so those who are in Singapore can appreciate all the companies that have already been touched by this single shareholder commitment. SGX also requires all listcos to have a sustainability report, and it's fairly common in sustainability reports nowadays to also have a section on your greenhouse gas emissions. And I'm hearing that the trend would be that potentially all SGCo incorporated companies, whether you're listed or not, will have some sort of sustainability reporting obligation in the near future. So this is an industry that has already developed. I've talked about the pressures from stakeholders, shareholders, your staff. This is not something that any company can wish to go away. There's a clear industry trend, and all the protocols and all the standards are there to learn about how you can measure and report. you cannot control what you cannot measure. So reporting is the first step, and then you look at reducing.
Thank you. If I could just add on to that, I completely agree that now's the time to get moving. We've got to start taking action. And the tough part about it, and a lot of people we speak to, is that it's in a voluntary space, it's going to be a cost. It's not a large cost, but it's going to be a cost. But key, I also echo completely what Felix said, and he's outlined already. There are a variety of different ways you can measure your own footprint. There are a variety of different ways you can understand what it means, what are your greenhouse gases, and what can you start doing around it, and start taking those steps. We in a voluntary space do not limit anybody coming onto our platform. We are largely set up and structured for a buy to retire journey. As I said, our secondary platform is only coming up towards the end of the year. So we do encourage anybody who'd like to, please go to the website, sign up. It's coming onto our community, is simple, and a simple email address, and you can be onboarded. And then you can start learning, then you can start understanding the different ways of coming to market. Just going back slightly to what Peter was saying earlier, it's those risks you don't know that's going to come up. It's those things that are going to change. And one thing I can guarantee you, that this environment will change, and it's moving at breakneck speed at the moment. But just think levelly about what you're trying to achieve. What is your objective? What are your goals? What are you mapping out to achieve? And for us, it's really becoming responsible about our own footprint and what are the ways we can do about improving it, and thereby starting to the variety of different levers you can pull, but thereby ultimately making it a change to the world. And it's really what we're trying to facilitate here.
Mark, thank you very much, and Felix as well. We have a few minutes left, and Peter, I wanted to ask you a question. One of the acronyms among many that have cropped up in our discussion is CORSIA, and I wondered whether you might be able to, probably not do justice to the complexities of CORSIA, but in a couple of minutes, explain what CORSIA is and why it's relevant to the discussions that we've been having, because I think it is an interesting example of another form of emissions trading and a new market that's coming up on the horizon.
So CORSIA is a sectoral tool. It's basically designed for aircraft operators to meet their obligations or commitments under the ICAO framework towards climate change. So just so people can set the scene and understand the context, the Paris Agreement looks at the greenhouse gases of its constituent countries, so Paris Agreement countries. The airlines mostly emit their emissions when they fly in international airspace. So GHG emissions for airlines for domestic flights are caught by their national Paris Agreement commitments, but for their international flights, their greenhouse gas emissions are not caught by the Paris Agreement. So again, the question is, well, I can understand me taking off from Singapore and landing in the UK, but in the middle, I'm flying over a whole bunch of different countries. That's international airspace. How do I allocate the emissions associated with that flight to any one of these countries? And the answer is we don't. We land up allocating it towards the airline, and the airline has a supervising state, and that state therefore manages the CORSIA commitments of that airline. And the airlines are governed by essentially a separate international treaty called ICAO, the International Civil Aviation Authority, and they have a CORSIA, a mechanism called CORSIA, which says airlines commit to reducing any of their greenhouse gas emissions that exceed their growth above a baseline set by 2020. So to the extent that airlines fly enough flights whereby the amount of emissions that they emit are higher than their 2020 baseline emissions, then they must find carbon offsets of the sort that Mark might be selling onto their platforms and retiring them against their aviation emissions. Now, the reason why CORSIA units are interesting is because CORSIA has done something quite unusual. In the clear divide of compliance world and voluntary world that up till now we've been talking about, CORSIA have gone in and said, I will allow airlines to use both, right? So I will allow them to use ITMOs and 6.4 ERs from the Paris Agreement Article 6 markets, and will also allow them to use voluntary market credits towards meeting their offsetting obligations under CORSIA, which is great, except for the fact that it creates an accounting nightmare now, because now you have credits that are voluntary on the one hand, and therefore don't necessarily overlap with the Paris Agreement accounting treatment. And you have Paris Agreement credits, which are definitely subject to Paris Agreement accounting treatments and a problematic thing called corresponding adjustment. And now you get into this debate about whether or not voluntary credits must also be correspondingly adjusted, or are you creating a two-tier market whereby some airlines can choose good credits and some airlines can choose other credits in the voluntary space that just don't have that same double counting avoidance concern. So you get into these weird things caused by CORSIA picking a product that is a hybrid in one sense, compared to where that neat divide between compliance and voluntary markets used to otherwise exist. So there is confusion awaiting the CORSIA market for vintages that overlap with the start of the Paris Agreement accounting period, which is the 1st of January 2021. So yes, I look forward to helping people resolve that particular jigsaw puzzle as well.
I think as that illustrates, there's so much more to unpack and to come and to develop in the context of emissions trading, and there are close connections for dispute resolution lawyers. So with that, we've come to the end of our time. I'd like to thank Felix, Mark, Peter, for your time, your participation. It's been an incredibly rich and interesting discussion, and I'm sure those in the audience have learned a tremendous amount from you. So thank you for that. And thank you also to SIAC for hosting us. It's been a pleasure to be your moderator today. Thank you for everyone who's attended, especially those that have lasted till the very end. We're really grateful. Have a good day, everyone.
Thank you.
Claire.
Thank you.
Great job.
Bye.